Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we break down the market action as stocks plunge amid Trump's sweeping tariff announcements. We'll have full coverage for you ahead. Plus, we look at what the market technicals signal about the next direction for stocks moving forward here. And we're going to dig into the sector action as auto tariffs go into effect today. And then we'll tell you which sectors are potentially going to be spared from levies. We'll get you those details ahead. Half an hour into the start of U.S. trading, let's get a check of the markets here. Taking a look at the major averages, you are seeing selling across the board here. I want to take a look at your S&P 500 down a little over 3%, but your tech-heavy NASDAQ taking the majority of the hits this morning, down over 4.5%. I do want to take a look at the bond market because we continue to see yields coming in this morning here, and I'm checking to see we are nearing that 4% level on your 10-year. If we do hit that 4% level, that's going to be a critical level to watch this morning as we're continuing to see the bond market pricing in perhaps a growth slowdown, risks of inflation, a lot of potential concerns about the health of the economy as these tariffs are set to take effect. So we're going to walk you through all of the potential impacts for your portfolios. We've got a great co-host to break it all down with us today. I want to bring in Brian Levitt. He's the global market strategist at Invesco with 20 years of experience in the industry. He'll be here for the hour. So Brian, plenty to talk about this morning. Investors are freaking out. My DMs are flooded this morning with people who are stressed. How concerned should people be in this moment?
I think we should still be concerned because there were two things we were hoping on Liberation Day, that we would get some clarity around where this is ultimately heading, and that the tariff rates may come in lower than had previously been expected. So neither of those things happened. Look, I never went to medical school. I didn't take the Hippocratic Oath, but I do believe the first rule of policymaking is do no harm. And so we had a good setup for markets this year. I think most outlooks were generally favorable, a resilient economy and stable inflation. And so markets were priced for that, and we're moving in the other direction right now. I mean, this is clearly going to slow growth. The bond market is telling us that, but the additional challenge is prices will rise. So can the Federal Reserve respond to it? Markets are down a bit, but perhaps not down enough to reflect the new growth and inflation dynamic that we're heading into. Yeah,
I'm curious about why we're not seeing even more selling this morning. Do you feel like the market is pricing in how risky this is about to be accurately?
Well, I think the market is still hopeful that this isn't the end.
Yeah.
Right now, we've got some pretty big moves. Like, let's not forget, we had already, come off the highs pretty significantly. We've got some pretty big moves in markets, but yes, it's a market that still is waiting to see, are these the negotiating points? Or can tariff rates actually go higher from here? Or could we have a tit for tat reciprocal trade war? I mean, that would be the bigger challenge right now. I think the market's selling off, but not necessarily to the full extent, because waiting to see where we go from here.
At least not unless you were looking at small caps, which have officially entered into a bear market.
And that's your growth proxy, right? If you're going to look, what is this inflationary? Is this a growth challenge? How is the market viewing it? I mean, small caps are your growth proxy. The 10-year Treasury is your growth proxy. So it is a market telling you that growth in the United States is set to deteriorate pretty significantly.
All right, Brian, thank you so much. We're going to have you with us for the rest of the hour to break down all the news our investors need to know here. But as stocks are selling off, we are also seeing the VIX, the volatility index, spiking, currently above 27 and rising near the year-to-date high that we saw last month. Our next guest saying to expect continued and increased volatility to come. Here with us, we've got Liz Ann Saunders, Chief Investment Strategist over at Charles Schwab. Liz Ann, great to have you this morning. What are you thinking? Where do we go from here?
So I think what the market was pricing in with a 10% correction was maybe something around the base case. And there have been a lot of best case, base case, worst case scenarios trotted out in the last several weeks. And what we ultimately got was worse than the worst case. And I think there's many facets to it. I think the lack yet of clarity on how does one negotiate this, given the somewhat simplistic methodology around coming up with these tariffs rates, where everybody's trying to figure out, all right, so what has to happen for those to come down? And there's not much clarity on that. I think another important facet to all of this that is less discussed as we look at what likely will be many firms and economists raising their probabilities of recession, I think it's well better than an even odds at this point, is the tentacles from the equity market to the economy. We have household exposure to equities at an all-time high. It's risen for every single income bracket. And it makes me think of the 2001 era where we had an economic recession that probably wouldn't have been one were it not for the weakness in the equity market. So I think we have to put an increased amount of weight on what the market does, not just for things like will it trigger the Fed to do something, but what are the actual implications for the economy? And that's additive to the downside.
And also, we are seeing that the U.S. 10-year is falling below 4% this morning for the first time since October, just since we started asking you questions here. Lizanne, what is the bond market telling you about the health of our economy and about the amount of power that the Fed has to control this economy moving forward?
Well, in general, when bond yields are keying off the growth trajectory and prospects thereof and move down, you tend to see a positive correlation with equities. So lower bond yields, lower stock prices when the bond market is keying off growth. If the bond market were keying off inflation and we saw the move down without a commensurate hit to growth, that would be a much different story for the equity market. So I think the bond market continues to be in the driver's seat, but that yield comparison to stocks as to whether it's inverse or positively correlated is a function of why yields are doing what they're doing. And down on growth expectations deteriorating quite significantly, negative for equities.
Lizanne, when you think about a higher probability of a recession, what's your expectation for the equity markets? Is this, a garden variety, mild cyclical recession where you may have to go down 20, 25% like an early 1990s, or do you think it's something that could be more ominous than that?
Well, there doesn't appear to be any significant dislocations within the financial system. So that could be something that prevents this thing from getting much worse. But if we were to see a significant tightening in financial conditions, a blowout in credit spreads, then you would call into question then the health and stability of the financial system. There's one pretty consistent determinant of whether a correction turns into a bear market or not, and that is recessions. Corrections that have not been accompanied by a recession at some point in the not too distant future tend to just stay in correction territory. Those that morph into bear markets, it's a function of recession or not. So as you see recession probabilities go up, you're probably going to see bear market probabilities go up.
And we're also seeing that traders are now fully pricing in a Fed rate cut in June. Previously, that was July. I wonder, Lizanne, how you are thinking about how these tariffs frame the market's reaction to economic data moving forward. Are we going to be back to bad economic news being good news because it gives the Fed an excuse to cut earlier?
I doubt it. I think, and at some point you get to that component or that piece in the cycle where easier monetary policy is sufficient to kind of right the economic ship. But I think it's premature to say that any kind of bad news, particularly on the labor market front, simply because it allows the Fed to ease. I'm not sure a 25 basis point cut in the Fed funds rate sort of cures the ills of what we're likely to see in terms of tariff-related impact. Not to mention the Fed is still in a bit of a pickle because in an environment where the economy really deteriorates, given tariffs, you're probably not going to see that commensurate deterioration on the inflation front, which means they have to make decisions in the context of both sides of their mandate not sending the same message.
How do you think this ultimately settles? If the Federal Reserve can't do it with a 25 basis point cut, will we have to see greater clarity on the trade side, on the fiscal side? I mean, what are you looking for to get a sense that we may be at extreme volatility or markets may be bottoming out?
I think it has to be more clarity or just an improvement to the trade backdrop. Again, I think just a simple shift in the monetary policy reaction function to being biased back in easing mode doesn't seem like that is going to cut it. I think we also have to get through first quarter earnings season and reporting season because I think it's a fairly easy guess that what companies are going to discuss on their conference calls is any profit margin pressure they see. volatility. And what is still a consensus expectation for double-digit earnings growth in 2025, albeit down from where we were at the beginning of the year, is still predicated on very healthy profit margins and not much compression. And I think that is a clear sort of forward-looking trajectory that's now being called into question. So I think we would need to see some stabilization there. And I think we're just at the beginning of the process of any kind of re-rating that's going to happen on the profit margin side.
To what extent does the Fed have the tools to combat any weakness? Like you mentioned, obviously, the wealth effect of the equity market sell-off continuing here, but also any macroeconomic weakness. Does the Fed need fiscal policy to come in a little bit more in line in order to be able to help this economy?
I guess it depends on how you define fiscal policy. One of the frustrations in my mind to a lot of the shorthanding that's done with regard to headlines is that this will all be offset by upcoming tax cuts. We have to remember that what's being discussed here, for the most part, is the extension of 2017's tax cuts, not a whole bunch of new tax cuts, other than on the margin on overtime and Social Security and tips. But that's very different from the backdrop in 2017 when the administration offered the candy first, and that candy was massive tax cuts, which gave a boost to the economy, got the spinach later via tariffs, which were much narrower, much smaller in scope, and didn't have that retaliatory element to it. Now we're clearly getting the spinach this time, and it's much more significant than what we saw. It's not really candy, other than thinking that if those tax cuts are not extended, that would be a massive hit to the economy.
Lizanne, before we let you go, this is one of those moments in markets where it's kind of breaking through the fourth wall, and we're getting messages from friends and family who never watch the market and are freaking out about their 401ks this morning. Just want to get a chance to hear from you. What is your message to those folks who are starting to panic about the health of their retirement accounts moving forward?
Well, panic is not an investing strategy, and we always like to remind people of that. So if the goal is to try to, fully get out and then get back in at some future moment in time, get in and get out are gambling on two moments in time. That's not an investing strategy. So all along, investors should have been mindful of diversification across asset classes. The fact that international has trounced U.S. That was not a big story because everybody just assumed, or a lot of investors assumed, the U.S. is the only game in town. The concentration risk that became really, really prevalent given the dramatic outperformance of the Magnificent Seven, that has completely been turned on its head. So that rebalancing discipline would have aided investors in this kind of backdrop. And unfortunately, you sometimes learn the hard way that those tried and true disciplines around diversification across asset classes, periodic rebalancing, which just forces us to trim where there's been outsized gains. We sometimes learn the hard way that there's a big gap between what we think of as our financial risk tolerance, kind of what's on paper, and then our emotional risk tolerance.
Lizanne, really great response there. Thank you so much, and thanks for breaking all that down for us. Really appreciate it.
My pleasure. Thank you for having me.
We're going to have all your markets action ahead, so stick around for more. You're watching Catalysts. Chip makers escaping specific tariffs as President Trump announces new levies on imports to the U.S. Still, chip stocks getting dragged today along with the broader market. Joining us now, Stacey Rasgon, Bernstein's managing director and senior analyst. Stacey, great to speak with you. You say that semiconductors will still feel an indirect hit from these new tariffs. How are you calculating the impact here, and what does that look like?
You bet. So semis, they will get hit by the baseline tariffs, this 10%, although I would say we don't import that many raw semiconductors anyways. It was $82 billion worth of raw semis in 24, and not a lot from any single country. I think Malaysia and Taiwan where they were most, but even then was 16 billion from each. A 10% increase, semiconductor ASPs are up 50% over the last 5 years anyways. That's okay. The issue is the indirect. The products that the semiconductors go into are going to get hit by tariffs. And that's the thing. Most semiconductors come into the U.S. inside other things like PCs, like smartphones. And you can actually look like where is the U.S. importing things like computer hardware and smartphones from. And just to level set you, in 2024, the U.S. imported close to $200 billion of compute hardware, servers, PCs, that sort of thing. About $114 billion of smartphones were. And if you sort of look at the locations and then the tariffs that are coming from those locations, My math suggests something like a close to a 40% tariff on computing hardware and smartphones that the semiconductors are going into. Cars as well. We did $350 billion of vehicles and vehicle parts in 2024. Those will get hit by a 25% tariff. And so the issue really is not so much the direct impact. It's as these products now get more and more expensive, is their demand destruction.
Yeah.
If we're selling fewer of the products that the semis go into, that's the bigger risk. The other risk for semis is just they're very cyclical and very global, and they're very correlated to the macro, to GDP. So if this tips us into recession, that's probably not going to be great. And so that, I think, is where the semiconductor stocks are actually moving, rather than like worries about like the direct impact of the tariffs themselves.
Yeah, Stacey, which is worse for chip stocks? A tit for tat on tariffs that allows for them to continue to get worse, or a scenario where companies just sort of pause across the board on spending as they wait for those negotiations to unfold and hopefully get better?
Well, I mean, I think those two things are coupled, right? They're not independent, and they're all. And by the this isn't just semis, by the way. I don't think there's any sort of good news really for anybody out here. So this isn't specifically a semiconductor related issue. This is an everybody issue. But yeah, I mean, if you're worried about escalation, both from other countries as well as from the U.S., that becomes a problem. And I think the point you make just about like paralysis is a very interesting one and very true. I mean, this is part of the issue. Like, how do you make plans that are going to take years potentially to put into place? Like, if we want to bring facilities and infrastructure back to the U.S., how do you make plans if you're not sure what like next week is going to bring on the stuff? Or people may even just wait if you've got a project that's going to take like 3, 4, 5 years to bring to fruition. Anyways, this administration will be out of power by then. Do you just decide to wait until the next one? Maybe everything comes off. So that just the general worry about decision paralysis, I think, is a big one. And again, for semis, and I think also like for the broader industries as well.
Stacey, how should investors balance the concerns about near-term demand destruction with the prior excitement around the long-term structural theme of artificial intelligence?
Yeah, well, I think that theme is probably still real and still there. Again, we'll see if any of this stuff has any near-term implications for CapEx spending and that. But I think AI is actually one of the themes that, like, through this probably can work. And frankly, if we want higher productivity and everything else, we may need something like that anyways. I think in the near term, none of that is going to matter, though. Like I said, this is going to overpower near-term decisions. Like, everything is going to get whacked. Multiples in general are going to come down. Like, I mean, just we're in an environment where, uncertainty is going to be higher. Cost of capital is clearly going to be higher. Multiples are going to come down. And we'll have to see where that bottoms. I think part of the other issue is, I mean, like on the surface, like this, it seems stupid and self-inflicted, right? And so you have to sort of wonder as to the mindset of the folks who are in charge, who are like bringing a sledgehammer to this. It is going to make people concerned, again, broadly about like what sort of discount factor to put on those future cash flows. And that's what we're seeing today. Like, it's not like earnings and everything all get revised like necessarily today, but like multiples are clearly going to come down, and semis are going to get hit by that, just like everybody else will.
Well, to that exact point, Stacey, Nvidia was cut to hold at HSBC this morning off the back of concerns that they have limited pricing power, and that's going to be a hit to earnings. Where do you stand on that argument?
They have limited. I'm not sure they have limited pricing power. I'm not sure. They have. I mean, they're running 75% margins, and frankly, people are lining up out the door to buy their products. They probably have more pricing power, frankly, than anybody else. Although I would say semiconductors in general do tend to have pricing power. Again, you can look through COVID just because of the inflationary pressures. The average semiconductor ASP today versus, say, 2019 is up 50%. So I think the industry, and by the way, people still bought semis. I think the industry in general probably does have better pricing power than a lot of other industries. Like, if I was selling T-shirts or shoes or something, I would be more worried about my ability to price the tariffs versus like semiconductors, especially if it's like a 10% lift. I'm not too worried about that. I think the broader disruption, and like I said, the worry about demand destruction at the end unit point is I think bigger worries. And I don't think those are isolated to Nvidia. I think those are broad worries across the space.
I think I'm still sitting here with an iPhone 6, so I might be part of that problem. What do you think, what's an expectation for what the damage may look like, and how excited do you get around where valuations may be going on some of these great long-term theme names?
Yeah, I to be honest, I don't know like how big the damage will be. Again, if it was a direct impact, you can size that. We've done that. It's fine. The indirect impacts and demand destruction, I don't know, because you need data on price elasticity for a gazillion types of end products. Like I don't have that data or analysis. I don't know exactly how to size the general impact from this. It will, again, if this continues, and the macro gets worse, it'll probably be sizable. And again, not just semis. Again, I don't think this is isolated to semis, but the impact will probably be big. So I don't know how to size it though. I wish I did.
Stacey, thank you so much. Love getting your thoughts. Really appreciate it. Brian, I do want to go to you quickly on this. How are you advising clients on the tech trade with so much volatility and uncertainty?
I think investors need to be concerned about names that are overvalued, right? And so when you get in these types of environments, I think the hope had been that you get a broadening of a market the good way, right? A synchronized global recovery and leading indicators and economic activity. We're getting it the less good way, which is investors are assessing where growth goes and bringing down multiples on stocks. And so those that have been the highest priced, what goes up tends to come down harder. So I would say investors should focus on quality, but focus on quality that has better valuations than what you see in the tech sector right now.
All right, great overview, Brian. Thank you so much. You're going to stick with us here. We'll have all your markets action ahead here on Yahoo Finance. You're watching Catalysts. We're about an hour into the trading day with stocks plunging as President Trump announces sweeping new tariffs. Julie Hyman is here now with a closer look at the market action. Hey, Julie.
Yeah, this is not what you want to see on a day like this. We opened lower and now we're going even lower from there. Now, there's a lot of time left in the session, obviously, but nonetheless, not a great sign here that we now see the Dow down 1,500 points, 3.5%. The S&P 500 similarly is now down nearly 4%, and the NASDAQ is down 4.8%. Just looking at some of the other asset classes that we're watching here, the Russell 2000, not in a bear market, but it's actually heading towards one. We're watching closer to, actually, we're getting pretty much there here, a 20% drop from the high to the low. We'll keep an eye on those numbers, but I think we might be there for the Russell 2000. And then elsewhere here today, of course, you would expect to see an uptick in volatility. That is what we are seeing here to levels not seen since earlier this year with the VIX at above 27. And then we've been talking a lot about how there's not really any place to hide in the market here today, that there is not any place where you're seeing positive returns. One of the places we are seeing money go into is treasuries. And with the price up, we are seeing yields down. This is a very large one-day move in treasuries of 18 basis points here. And you see what yields have been doing all year long. As we have talked about, the Fed is in a little bit of a tricky situation here. If tariffs are going to cause persistent price inflation, then that potentially limits their ability to cut rates. Nonetheless, that is what analysts and traders now seem to be expecting. The dollar continues its slump as well. Again, here's a year-to-date chart, and the leg lower that we are seeing today in the dollar is once again substantial. Crude oil is down sharply here today, off by about 7% on the session, below $67 a barrel, as OPEC also announces output increases. So bringing more supply to market in the face of the tariffs. That's sort of a double whammy. And if you think you can hide in gold, think again, because that is also down today. Digging into stocks a little bit, we have seen a lot of the selling centered in large cap tech as of late. But here today, it's actually more broad based. While we see the NASDAQ leading in percentage terms, but really you see a lot of other types of companies also declining. Meta, it looks like, and Apple are the worst two of the Magnificent Seven at the moment. Apple down 8%, Meta down 7%. And if we equal weight it here to see what's doing the worst, it's actually not the pure tech stocks within the NASDAQ 100. You've got Lululemon that is falling sharply because it rejiggered its supply chains, moved a lot of it to Southeast Asia. Well, guess what? Southeast Asia is getting tariffed. You've got Atlassian, which is a software company, Trade Desk, Micron. So kind of a split here. Dollar Tree, though, is on this list as well. Obviously, they source a lot of their goods from outside of the country. And then if you look at the Dow real quick as well, and again, I'm going to equal weight it so we can get a better look. Nike, the worst performer there, down by 13% right now, Maddie.
All right, Julie, thank you so much. President Trump's 25% tariffs on cars imported to the U.S. officially taking effect today. Automakers responding to the new levies. Volkswagen planning to add import fees to the sticker prices of its vehicles shipped into the U.S. Meantime, Stellantis pausing production at some plants in Canada and Mexico. And Ford, benefiting from its larger than average inventory, announcing discounts for customers. Joining us now to break it all down, Diana Lee, Constellation CEO. Diana, great to speak with you. Just ran through a lot of the impact we're seeing on individual names, which I know you follow very closely in your role. Talk to me about who is best positioned amid this moment.
So I think the most interesting part about all this is just because tariffs are actually announced as of today, it's not like it's going to get affected immediately. So what I mean by this is there's a lot of cars being imported right now into the US. Those vehicles were ordered over 2-3 months ago by the distributors and the manufacturers. So even though they're coming in, it's not like those vehicles, they can go back to the original distributors and say, hey, you're gonna get a tariff today on those vehicles. So how the impact is really gonna happen is truly 2-3 months from now. Because as those orders are happening as of today, the tariffs will actually be a part of the pricing. There are some manufacturers like Hyundai that said that they're gonna actually eat the tariffs. The most interesting part about this is even if they eat the tariffs, offers are gone for new vehicles. You can't eat the tariffs and actually have a 2.9, a 4.9, or incentives on these vehicles. So if offers all go away, the prices of every vehicle, even if they eat the tariffs, will still be higher. So there won't be any incentives. Yeah. Supply will also be a factor because people are trying to figure out where to actually distribute the vehicles to actually have lower tariffs. But what people don't understand is based on the parts of every single car. So even Tesla and Rivian, who actually make all their vehicles here in the United States, will still have tariffs on the imported parts. Tesla has imported parts coming in from China. They have gone to the U.S. Trade Administration to ask for an exclusion.
Mm-hmm. Yeah, do you anticipate any of those exclusions, any negotiations moving forward?
Yes, there's negotiations all happening in the background. And the frightening part of this during the negotiations is some of the OEMs are basically saying they won't actually supply the U.S. any vehicles. Right. Now, what happens then? It then would mean that U.S. would actually lose jobs because you wouldn't have jobs here in the United States with all these automakers actually. Whether they distribute as they distribute into the U.S., there's a lot of U.S. citizens that work for many of the auto manufacturers. So if they start laying off because of the fact that they can't distribute supply here, then it will affect jobs in the United States.
So the expectation is the average life of a car on the road will just go up?
Exactly. Yeah. So all new vehicles coming in the next 2 months will start actually climbing. And then the vehicles here will also be more expensive because right now we're at an all-time high of car sales because people know the tariffs are happening. So March was an amazing month. April will continue because all used vehicles, people are going to try to get those vehicles, and new vehicles that are currently on the ground will not have the tariffs and currently have incentives.
Pulling forward that demand. Will we wake up in a moment when the car companies will just not be offering some of the names that we're used to, some of the models that we're used to?
Exactly. So what's going to end up happening is the cars that are more expensive to make because of the supply disruption, they will not make those vehicles anymore. Those models will start going away. And then the frightening part is some of the OEMs are basically saying they won't actually give any supply. Well, if that happens, we will go bankrupt here in the US for those automakers, and all those jobs will be eliminated.
Where, for consumers who are really concerned about the price hikes that are going to be happening here,
Sure.
What is your advice to them? Is there any specific model out there that is most likely to have the smallest price increase?
Yes, so amusingly, obviously, it will be Tesla. Tesla will be the winner in all this. And that's also scary to me because there's 25 traditional automakers that have all funded the US American economy. And so from there, because parts are also more expensive, the consumers would actually have to pay for servicing of the vehicles at a higher rate as well. So anything to do with auto will end up going up. Hyundai has announced that they're actually advertising vehicles on Amazon, but that's at MSRP. And so as it's at MSRP, there are no discounts. Discounts are going to disappear on vehicles right now because short on supply, no offer and incentives. It's exactly like COVID years coming back. COVID, no supply of new vehicles, right?
Right.
No incentives on cars. That's going to happen again.
I do want to ask, too, on a stock market level, it's interesting. We're seeing Goodyear ripping this morning. The stock was up as much as 17% earlier. Now it's up about 10%. And you can see that on your screen here with our Yahoo Finance platform and our tools there. Diana, what does that move tell you about where there is opportunity for investors right now? And then, of course, the end impact to consumers.
Yeah, so parts that are assembled here in this country will definitely be a winner. As supply chains are all changing right now, it may come out that there are announcements like Hyundai saying that they're going to put investments here in this country and start building plants. And so there's going to be winners and losers based on who is actually producing all parts and all auto products here in the United States. That's really what's happening. And there's a lot of background conversation right now with President Trump in terms of negotiating future rates of actually producing things here in the country to avoid the tariffs right now.
Diana, thank you so much. Come back soon. Really appreciate your insights.
Absolutely. Thank you so much.
Appreciate it. One trending ticker we're watching today, RH, Restoration Hardware shares plunging by the most on record amid dual hits to the stock, tariffs and disappointing earnings. A tough day to have your earnings print on Liberation Day. The luxury furniture retailer expecting a, quote, higher risk business environment this year due to the uncertainty caused by tariffs. Meantime, the luxury home furnishing company's annual revenue growth forecast trailing Wall Street expectations. Fourth quarter sales and profit missing the average estimate. Analysts at Citi downgrading the stock to neutral amid the results and looming tariffs. Barclays analysts adding there's, quote, significantly more uncertainty with the new round of tariffs, adding risks to both sales and margin recovery. RH, which operates the Restoration Hardware chain, sources about 70% of its products from Asia, according to company filings. Vietnam and China account for more than half of that total. On Wednesday, Trump announced tariffs including 46% on Vietnam, raising China's total levies to at least 54% on many goods. The retailer conducted its earnings call shortly after Trump's tariff event. Again, a tough time to have an earnings call. That stock continuing to move to the downside. Coming up, pharmaceuticals were granted a tariff exemption, but we are diving into why drug makers, they're not out of the woods yet. Stick around. That's next.
We're going to produce the cars and ships, chips, airplanes, minerals, and medicines that we need right here in America. The pharmaceutical companies are going to become roaring back. They're coming roaring back. They're all coming back to our country because if they don't, they got a big tax to pay.
President Trump granting pharmaceuticals an exemption to his hefty reciprocal tariffs alongside semiconductors, lumber, copper, and some minerals. But the industry is already bracing for that to change, with Denmark's benchmark index entering into a bear market amid concerns about Ozempic maker Novo Nordisk and potentially some tit for tat there. I want to bring in Stephen Ezel. He is Information Technology and Innovation Foundation's VP for Global Innovation Policy. Stephen, great to have you here. Pharma, somewhat safe for now? Where is it heading in your view?
Yes, pharmaceuticals were exempted today. However, we have been continually led by the Trump administration to expect that the drug industry will see tariffs at some point in the future. There is word out that the administration may open a Section 232 investigation into pharmaceutical imports in the United States. Section 232 investigations are opened under national security grounds. So while the industry is out of the woods for the moment, we may see tariffs in the future. It should also be noted, as your viewers see today, that while the pharmaceutical industry won't experience tariffs directly, there is no industry, business, or citizens that will escape unscathed from these tariffs today. In particular, these tariffs are going to make drug innovation and drug manufacturing in the United States more expensive. If you think about it, to innovate drugs, we have to have very sophisticated equipment like gene sequencers or scanning electron microscopes. To manufacture drugs, we have to have vacuum pumps and biosafety cabinets. These inputs and components come from suppliers all over the world. So even though the pharmaceutical product will be not exposed to the tariff, all these inputs and components will, and that's going to make U.S. pharmaceutical manufacturing going forward less globally competitive.
When do you think the U.S. consumer will start to recognize? I mean, they're coming for our Ozempic and our Botox, right, and a significant amount of the generic drugs. What's your expectation for when Americans could start to feel some pain?
Well, I think that as companies see that their cost of innovation and manufacturing are going to rise in the future, we'll see that starting to flow through into prices for a wide variety of products almost immediately, and I would not expect this industry to be any exception.
And to that end, what are you thinking in terms of the potential of retaliation with the likes of Novo Nordisk, for example, and how that could impact some of those prices for goods?
Well, the Trump administration in this case is like a chess player that only thinks on the offense and not looking at what the retaliatory countermeasures will be. And one thing we have to recognize as well is that even though the Trump administration hasn't imposed tariffs on these pharmaceuticals, as other countries look at the suite of tariffs they may put in place to retaliate against the U.S. tariffs, pharmaceuticals could very well be one. So this is going to harm American companies' ability to sell their products into foreign markets going forward. And I think if you asked about, Denmark in particular, Novo Nordisk, I think what we're seeing in these cases is a recognition that, the average American household is going to pay $3,000 to $5,000 more for goods by the end of this year as a result of these tariffs broadly. And that is going to have an impact on all sorts of downstream or discretionary purchasing in the United States. And this is why every industry, including life sciences, is seeing the hit from these tariffs today, because the economy is going to decrease. It was pointed out that as a result of this, Denmark may tip into recession. But global GDP is expected to decrease by 0.5% this year, including for the United States. The chances of a recession in the United States are now at 35%. So purchasing of all goods, discretionary or not, are going to decrease. Right. And something like Ozempic, which you need, but perhaps not as much as a cancer treatment, are going to be hit even more.
Stephen, great overview. Thank you so much. Appreciate it.
Thank you.
Coming up, why top U.S. executives are warning about major harm caused by the president's trade policy, and what they're telling the White House as well. That's next. Some breaking news crossing the wire here. Stellantis, the maker of Ram trucks and Jeeps, planning to temporarily lay off 900 workers at 5 U.S. facilities after President Donald Trump's tariffs were announced. Now, this comes as Stellantis the company is pausing production at 2 assembly plants in Canada and Mexico. The company attempting to navigate President Donald Trump's new round of 25% automotive tariffs that took effect on Thursday. The actions are the swiftest and most dramatic by automakers regarding these new tariffs tariffs, which are imposed on all vehicles imported into the United States, including from Canada and Mexico here. Just to run through a little bit more context here. So we do know that Stellantis, again, the owner of Jeep and Ram brands, the company saying on Thursday that they are pausing these additional plants at Canada and Mexico here moving forward. The COO saying with the new automotive sector tariffs now in effect, it'll take our collective resilience and discipline to push through this challenging time. Again, those projected layoffs, 900 workers, that is expected to kick in on Monday. And that is, of course, not the response perhaps that United Auto workers were anticipating when they came out in support of these tariffs. We're now seeing the impact of profit margins kicking in at these companies and perhaps the sign of potentially more layoffs to come at these automakers. Well, in a response to President Trump's broad tariffs, Business Roundtable CEO Joshua Bolten wrote the tariffs, quote, run the risk of causing major harm to American manufacturers, workers, families, and exporters. Damage to the U.S. economy will increase the longer the tariffs are in place and may be exacerbated by retaliatory measures. According to a report from the Wall Street Journal, corporate America is concerned about the president's trade policies. For more, I want to bring in Nick Timrose. He's the Wall Street Journal's chief economics correspondent. Nick, fantastic to talk with you this morning. I know that you have been speaking with corporate executives. You obviously cover the Fed very closely. I just want to get a sense. Have you heard anything different from corporate executives since these tariffs were announced last night? And what can you tell us?
Well, if there's any good news, it's that you now know, what the cards are on the table, and whatever uncertainty was there before, obviously it hasn't gone away, but you now kind of know what you're dealing with. I think the problem is that nobody likes what they're dealing with here. These are larger tariffs than what most people expected. These are larger than what Trump himself had run on during the campaign. You recall he had run on a 10% across the board tariff and 60% on China. It seemed like China, as was the case in the first term, was going to be the focus of trade policy changes in the second term. And so these tariffs announced yesterday, Madison, were just much larger than what people, even at the more pessimistic end of things, had been expecting.
Nick, where is the voice of the business community in all of this? I mean, I remember during past presidential terms, if there was something that the business community didn't like, they were quite vocal about it, or the Chamber of Commerce was quite vocal about it. Are you surprised that we're seeing it show up negatively in the survey data, but we don't hear a louder voice from the business community?
Well, I think you look at some of the other things the administration is doing, targeting universities that have taken positions that maybe the administration doesn't like, going after some of these big law firms. And so you may see a culture of fear. Nobody wants to be the first to file the lawsuit challenging the constitutionality of these tariffs. Nobody wants to be the one to stick their head out and have it get cut off. There could be some of that here. I think there's also been just let's see what this is before we go DEFCON 5 and fighting it.
And you had a piece out this morning in the Journal on how tariffs aim to create a new world economic order. Nick, it's not just the U.S. that is at risk of entering into a recession because of these tariffs. What are your sources telling you about the risks globally for an economic slowdown?
Well, it really isn't about sources at this point. It's about you look at what the markets are doing right now. The administration has been saying short-term pain for long-term gain, but the market doesn't see it that way. The dollar is down, bond yields are down, stocks are down. People are talking about higher inflation this year, but with more rate cuts from the Fed later on to cushion the hit to growth. I think what you see here is Wall Street going through the 5 stages of grief. Where we're clearly out of the denial stage now, but whether we're in anger, bargaining, depression, I think it depends on your perspective which one you're in. We're not at acceptance yet. That's what we're seeing happen this morning in the markets.
So Nick, really quick, if we're going through those 5 stages of grief, what does it take for the corporate executives who speak to you anonymously and say that they are fed up with these policies to be a little bit more vocal in order to get the president to pause on some of these policies?
I think that's a great question. I don't think we know what it's going to take. And we're sort of in uncharted waters here.
Yeah.
So we'll just have to wait and see. I think that's the right question right now is people are asking, where's the Fed put? I think the question is, where is the White House put? At what pain point do members of Congress and businesses begin to put pressure on the White House to negotiate or do whatever is going to happen here?
Nick, got to ask you about the Fed, my favorite Fed correspondent. We're hearing from Powell tomorrow. How do you think he's going to respond to this, and where do you think this puts the Fed moving forward?
Well, it puts the Fed in a very difficult position. That much is clear. As to what Powell says, he's been very careful recently. There isn't a big incentive for the Fed right now to be drawn into something that is the administration, putting out these policy actions that the markets don't like. So the Fed at a certain point will have to react to weaker growth. But if inflation's going up, it gets awfully harder for them to do that. One other point I would make is that, what do rate cuts accomplish? They help interest rate sensitive sectors of the economy like housing and autos, but those also happen to be two of the most trade affected sectors. So people here thinking that the Fed can run to the rescue, I would sort of curb your enthusiasm about that. If housing, costs to build houses, costs to put together cars are going up. I don't know what interest rate cuts are going to do to cushion that hit.
A little bit hamstrung, at least at the Federal Reserve level. Nick, thank you so much. Really appreciate it. And thanks to Brian Levitt for sticking with me for the hour. Brian, great to have you. Really appreciate it. Thank you. Thursday's tariff-fueled sell-off wiping billions off Wall Street's biggest names. Here are the biggest drops of the day. Host of Stocks in Translation, Jared Blickery.
Thank you. Let's start with Apple. That just crossed $300 billion down, and I'm looking at a tick a little bit lower here, down 8.8%. So here we have the S&P 500's biggest losers by market cap intraday here, and I could give you some impressive stats here, but I'd also note that Apple is about 20% down from its high. That's an important threshold. We don't say individual stocks are in a bear market, but that 20% level is catching a lot of eyes. Second up, we have Amazon. That's down 181 billion, not that bad. Nvidia down 180 billion, Meta down 120, and then it drops off from there. But we're seeing a kind of a broad smattering of different names here. We got JP Morgan, we have ExxonMobil. So even the energy trade, which has been kind of a bright spot this year against all of the turbulence, even some of those big names are down. Chevron down 5%, Caterpillar down 7%. And I'll just give you a couple charts here. And let's start with Apple. And I'll go the last 5 years because not all of these stocks are approaching these levels from the same price point. And here we have Apple in a recent high. But you take a look at Nvidia, the poster child of the AI trade. This stock has been trading sideways for over a year. So a lot of these names, you can look at these charts and say tremendous amount of distribution here. Makes you wonder where the downside targets actually are. Back to you, Maddie.
Certainly does. Also, the dollar now seeing the biggest one-day drop on record. Jared, coming up, wealth dedicated to all your personal finance needs. Stick around for more.